Our next guest, though, believes the charts are signaling a poor risk-reward setup from here. Joining me now, Jason Hunter, J.P. Morgan's head of technical strategy. Welcome back. It's good to see you. I mean, I just finished a conversation with somebody who is pretty positive on the market, but then I have a guy like Chris Harvey who says sell before May and go away, that it's not so great. What's your take?
Yeah, I would agree more with the latter. Ever since the market had gotten, the S&P 500 had gotten to 4,100 in early December, we shifted from a positive bias, which we adopted in the late September, early October period, when the index actually looked attractive at 3,600, to one that's, take your chips off the table, and even increasingly getting more and more negative as we move into this year and see the rotation that we've seen, where the risk reward does look very unattractive at these levels, and the asymmetry to the downside, even in our base case view, which is a retest of 3,500, is unattractive. And there's also the risks that come with slowdowns and recessions, the nonlinearities, the feedback loops that potentially could kick in. So certainly at these levels, we don't like holding risk here.
You have these events, though, like tomorrow morning, which could throw a wrench in what technical analysis would typically tell you to do. Isn't that correct?
Yeah, so with the CPI print that's coming tomorrow, we not only look at the world from through a technical lens, we do a lot of cross-market modeling and a macro overlay to our work. And one of the things we look at is the S&P as it's priced versus Fed expectations. We've been using a model for many quarters now that look at the terminal rate, how much easing priced on the back of that terminal rate, and given how dovish the market's priced, they effectively have the Fed going to roughly a 5% terminal rate, but 235 basis points of eases on the back of that. That's basically taking the Fed back to neutral. So could there be little shifts around the edges for that? We don't think that's going to be a huge game changer here at this point, whether that takes the terminal up and puts another hike into the forwards, or whether that speeds up the pace of eases. At this point, with the Fed priced back toward neutral within a 2-year period, give or take, we think that's as dovish as the Fed's going to get priced, unless you start to price in something like claims starting to move substantially higher or the demand side really breaking, which naturally wouldn't be a good thing for equities either.
If I give you a pullback, what's a key support level that I need to look out for?
So I would say tactically right around just above the 4,000 level for the S&P. A move below that would certainly sideline the bullish short-term momentum and start to get the market into CTA signal levels that could trigger some momentum-based selling. Bigger picture, 3760 has been the key support on this range within a broader range that's been playing out over several quarters now. In my view, the break below that 3760, that will be when market participants fully embrace the idea that we are going into a slowdown. And like I said, our base case view is an ultimate bottom near 3,500. We're waiting for that capitulation, though, before we suggest it's time to put money to work again.
How should you view, or how should our viewers view, what's gone on in tech and some of these growth names? Obviously, a tremendous rally that we've seen from the beginning of the year in NASDAQ. How vulnerable does that part of the market look to you?
So again, going back to that cross-market model that we use, pricing the various indices against the shape of the money market curve, things like the J.P. Morgan Economic Surprise Data Index, with that sharp rotation that started out in January as a position squeeze, where people were very underweight the quality growth names. That the first part of this rally that we've seen in 2023 was a short squeeze, or an underweight squeeze, let's call it. Everything over the past, let's say, month and a half, that's been seems like more of a chasing rally momentum to the upside. At these levels now, the NASDAQ is actually more overpriced versus the shape of the money market curve than the broader S&P is. And really what that is a very crowding in a handful of names. If you look at the market breadth as it's rallied over the last month, it's really mega cap tech and then the defensive sectors. Like today, we've had the occasional day where cyclicals have led. Today, the day where OPEC surprised with the cut in production, but that's been the exception. It's mostly been defensives and mega cap as money has moved to things like quality and the few big names within the NASDAQ. Given how much that rally's unfolded, though, we think at this point, mega cap tech may actually be more at risk than cyclicals when the data really starts to show signs of a slowdown.